imagine looking at a market and, seeing nothing but overlooked potential. Like a hidden treasure everyone else has just walked right past.
Mm-hmm.
What if entire national markets are like that, just sort of waiting for the right catalyst?
Yeah, that's an interesting thought.
Well, today we're taking a deep dive into South Korea's ValueUp program. It's this fascinating new policy that aims to do exactly that, to unlock significant corporate value that's, well, currently sitting dormant.
And it's getting quite a bit of attention.
It really is.
Yeah.
Our insights for this deep dive come from a source titled South Korea's Corporate ValueUp Catalyst. It gives a really clear look at what's happening and, crucially, why it could be a game changer.
Right.
So our mission today is to unpack the core mechanics of this program, understand its surprising upside, and maybe explore some of the specific strategic insights from this material.
Okay.
Get ready to see how policy can become a powerful force in market dynamics and corporate behavior.
Let's do it.
So if we're talking about unlocking hidden value, where do we even begin with South Korea's ValueUp program? What exactly is it?
Well, it's essentially a new mandate. It's really designed to make Korean companies more shareholder-friendly.
Okay. Shareholder-friendly how?
Starting August 2nd, companies are required to publish these detailed ValueUp plans. And the key thing is, these aren't just, suggestions. They involve firm commitments.
Firm commitments. Okay, now that sounds significant. What kind of commitments are we talking about here? Because firm commitment from a company is, well, it's a pretty big deal.
Exactly. Yeah, the core of it is that companies must commit to either share buybacks
Okay.
or setting dividend floors.
Right. Can you maybe unpack those a bit? Buybacks and dividend floors?
Sure. So when a company buys back its own shares, they're basically reducing the number of shares out there on the market, which can increase earnings per share and, in theory, boost the value of the shares that are left.
Makes sense.
And dividend floors, well, they guarantee a minimum payout to shareholders. So both are very direct ways to return value.
And they signal something too, right?
Oh, absolutely.
Right.
Crucially, they signal confidence from the management. It's their way of saying, look, we believe our stock is undervalued.
And we're already seeing some big names jumping in, aren't we? Our source mentions Samsung and SK Hynix.
Yeah, that's right. They've actually already pre-announced multi-tranche buybacks. That just means purchases spread out over time.
Got it.
And the total is, get this, $10 trillion over 3 years.
Wow, 10 trillion won. That's a huge vote of confidence and a massive commitment of capital.
It truly is. And this proactive move by major players, it really underscores the seriousness of the program and, the potential impact they see coming.
So it's not just talk.
Definitely not. But this isn't just about new regulations. It's really about a massive opportunity that the source points to.
Yeah, I was really struck by the sheer scale of the opportunity here. Our source points to some really compelling numbers. Let's talk about valuation. The KRX 200 index, it's trading at just 0.9 times its book value. That seems low.
It is very low, especially historically.
For our listeners, maybe a quick refresher on book value.
Sure. Book value is, well, essentially what a company would be worth if it sold off all its assets and paid off all its debts. It's the sort of theoretical value on the balance sheet.
So 0.9 times book value. That really contrasts with the index's 10-year median, which our source says is much higher, like 1.4 times.
Exactly. And that gap is significant.
So that low ratio just screams undervaluation, doesn't it?
It really does. And if you connect this to the bigger picture, this kind of persistent undervaluation, it's precisely what the ValueUp program is trying to address.
Right, trying to close that gap.
It's about closing that significant gap between the current market price and what the underlying assets suggest these companies are truly worth. This program, it acts as a kind of catalyst.
A catalyst for value recognition.
Exactly. Encouraging companies to actively demonstrate and return that value to shareholders. And look, this isn't just a theoretical upside either. The direct benefit is immediate. The source projects the buyback yield alone is going to be a solid 4 or 5%.
4 to 5% just from buybacks.
Yep. And that's before any potential multiple re-rating happens.
Multiple re-rating. Okay, that's a term maybe we should unpack a little. What does that mean for, say, the average investor listening?
Simply put, it means the market collectively decides a company's stock should trade at a higher price relative to its earnings or its book value.
So the market changes its mind about how much it's worth.
Exactly. It's the market adjusting its perception. And that shift, that re-rating, could lead to significant capital appreciation for investors. way beyond just the dividend or the buyback yield.
Okay, so there's the immediate return and then this potential bigger jump if the market perception changes.
That's the idea.
Given this persistent undervaluation, though, it makes you wonder, what does it say about maybe the traditional corporate culture in Korea? The K-balls, perhaps, that a policy like this is now seen as necessary.
That's a really good point.
Is this like a forced evolution or something else?
I think you could definitely argue it feels the forced evolution. You look at these huge family-controlled conglomerates, the cables, as you said, and you often see these complex cross-shareholdings, right? Historically, maybe more focus on growth over direct shareholder returns.
And the Korea discount.
And often, yes, what analysts call a Korea discount, which partly reflects governance concerns. So this ValueUp program, it feels like a direct response.
The investor pressure.
Yeah, years of pressure from both domestic and international investors basically saying, look, you're sitting on a potential gold mine, but we, the shareholders, can't seem to access it.
So it's a governmental push. Modernize corporate governance, appeal to a broader investor base.
I think that's fair to say. It's a significant shift in maybe corporate philosophy, nudged along pretty strongly by policy. This program essentially mandates greater transparency, greater accountability.
Pushing them to think more about shareholder value.
Right. Pushing companies to think more critically about how they return value, moving beyond just pure growth metrics.
Okay, so we understand the program, the potential upside. What does this all mean for someone looking to understand the practical applications? Our source gets really specific here, almost like a playbook.
It does, yeah. It gets very concrete.
Yeah.
It directly recommends buying Samsung Electronics common shares. The ticker is 00059330KS.
Okay, Samsung Common.
And Samsung Preferred Shares, ticker 005935KS.
And here's a detail that really jumped out at me from the source, the preferred shares. They trade at a 15% discount, but they get the exact same dividend as the common shares.
That's the key nugget.
Think about that same dividend, but the shares are 15% cheaper. It's almost like finding a hidden coupon in a really sophisticated market, isn't it?
It is. It's a specific market inefficiency that astute investors might look to exploit. So the recommendation to buy Samsung, especially the preferreds at that discount, it directly leverages the potential value unlocking from this ValueUp program.
Get the same payout for less capital upfront. Makes sense.
Exactly. And the source even goes a step further, suggesting a more advanced strategy. A pair trade.
A pair trade. Okay, now that sounds like something our listeners would appreciate digging into the thinking behind. How does that work?
Well, this involves going long Samsung preferred shares.
So buying the preferred shares, expecting them to go up.
Right, and simultaneously shorting the EWY ETF.
Okay, EWY. That's an ETF tracking Korean stocks, right?
Exactly. It's an exchange-traded fund that tracks Korean equities. And the reason for shorting it is specifically to neutralize the Korean won, or KRW risk.
Ah, neutralizing currency risk. So basically, you're trying to remove the impact of the won going up or down against your home currency.
Precisely. So your investment performance is driven more purely by how Samsung performs, not by unexpected currency swings. It's about isolating your bet on Samsung itself.
Isolating the bet. I like that.
Yeah, it's quite a sophisticated approach. By shorting the EWY ETF, the goal is to hedge against broader market movements or currency fluctuations that might otherwise eat into the gains from the Samsung position.
So you focus just on Samsung's value up potential, minimizing those external factors?
That's the aim. And the source gets very specific, even suggesting portfolio weightings, like 4% net asset value in the preferred shares, 2% in the common.
Wow, really detailed.
And it outlines risk management, too, using options, a very concrete, actionable plan laid out there.
They even mention a specific risk control measure. Using 6-month ATM puts on that EWY ETF. For listeners, ATM puts are at-the-money put options. They give you the right to sell at the current market price, acting like insurance if the ETF price falls.
Right, a hedge.
And the source noted this would cost about a 2.8% premium for that protection.
Yeah.
This whole thing raises an important question, I think. How do analysts actually translate these big policy shifts into such specific actionable strategies, down to the tickers and the options?
Well, it's really a combination of deep market understanding and forward-looking analysis. They're not just looking at what is right now, but trying to anticipate what will be if a policy like this succeeds.
Thinking ahead.
Exactly. These specific recommendations, and we should stress, they're from the source, not investment advice from us. They clearly illustrate the strategic thinking involved.
Right.
It's about identifying where the policy creates an advantage, whether it's through a discount like the preferred shares, or a guaranteed return from buybacks, or that potential re-rating.
And then building a trade around it.
And then building a robust trade around it, making sure to account for other market factors like that currency risk we talked about.
Okay. So just to recap then, we've taken a deep dive into South Korea's ValueUp program. We've looked at its core requirements, the significant upside potential it seems to present because of this market undervaluation, and explored some very specific strategic approaches outlined in our source material. It's just a fascinating example of how policy can be a direct driver of market change.
It really is.
Yeah.
And if we connect this to the bigger picture, I think this program really highlights how proactive government policy and subsequent corporate policy can aim to reshape market perceptions and potentially unlock substantial value.
A real case study.
Absolutely. It's a compelling case study in how a government can directly influence corporate governance and shareholder benefits. And that could lead to a reevaluation of an entire market.
Which, this whole discussion really begs the question, doesn't it? What other markets or companies out there might be similarly undervalued, just sort of waiting for their own catalyst?
Could be anything.
Yeah, maybe a policy shift or a change in corporate philosophy, or even just a new market perception starting to form, waiting to unleash that hidden potential.
Or even how policies like this might influence corporate governance and shareholder relations more globally in the years to come.
That's a great point, too. Definitely something to mull over.